All right, hi everyone. My name's Andy Ervin and I'm the Deputy CIO here at Alumni Ventures. Thanks for joining today's session. We're excited about today's topic of evaluating individual venture deals. Before we jump in, I first need to go through a few standard disclosures. So first, we're speaking today about Alumni Ventures and our views on the associated venture landscape. This presentation is for informational purposes only and is not an offer to buy or sell securities, which are only made pursuant to the formal offering documents for the fund. Please review important disclosures in the materials provided for the webinar, which you can access at av-funds.com/disclosures. And finally, a few housekeeping items. You will not be on camera and will be muted throughout the entire presentation. We will record this webinar and we'll share it with you after the event. I encourage everyone to submit questions throughout the webinar. To ask a question, please enter them through the questions section of your GoToWebinar control panel and click submit. Taylor, one of our investor relations managers, is supporting us behind the scenes and will help me field your questions. We've been amazed at the response and turnout for today's session, so if we don't get to your specific question today, we'll do our best to follow up. If you'd like to learn more about Alumni Ventures and investing in venture capital, I encourage you to book a call with one of our senior partners. They'd be welcome to speak with you directly, and Taylor will be putting a link into the chat section now where you can book a time on their calendar. He'll also include a link to our secure data room where you can explore fund performance details or begin the process to become an investor with AV. All right, so our presenters for today. So we've got Mark Edwards, our Chief Investment Officer here at AV, and myself, Andy Ervin, Deputy CIO. Before I hand it over to Mark to introduce himself, my background includes being here at AV for the past 6 years or so in various investing capacities. And prior to that, I was on the other side of the table running finance and operations at a venture-backed startup based in Boston. Prior to that, I was in strategy consulting at the Parthenon Group, as well as an actuary at Liberty Mutual. So Mark?
Great, thanks Andy. It's Mark Edwards speaking now. I'm the Chief Investment Officer at Alumni Ventures. In this capacity, working with Andy, we manage the activities of about 40 full-time investment professionals located in Boston, New York, Chicago, and Menlo Park, who face the market and do a lot of the investment analysis that we're going to kind of dive into today. By way of professional background, I joined Alumni Ventures about 2 years ago, full-time as a member of the executive team, but have been involved really since the company's inception as an investor and sometimes advisor. Professionally, prior to this role, had about a 2-decade career working in private equity at a handful of sort of multi-billion-dollar New York-based partnerships. But along the way, I was a pretty active early stage and angel investor with my own money, which is sort of how I got introduced to the company in its early stages, and happy to be here today. So Andy and I will sort of alternate as we go through the agenda and look forward to diving in.
Cool. And yeah, quick overview of the agenda. We're going to walk through venture capital as an asset class, essentially a quick overview of what venture capital is, and then a little bit more about AV's role in this space. Then we'll get into the meat of the presentation of how AV evaluates deals. We'll talk a little bit about syndications, which are really opportunities for AV investors to flex their deal evaluation muscles on their own. And then finally, we'll open it up for Q&A. So Mark, over to you.
Great, thank you. So we've got a relatively large audience today and had some requests in advance with some questions just to sort of make sure that we covered some overview material and kind of scroll back and make sure that we're all singing from the same hymnal in terms of what is the venture capital market and how Alumni Ventures specifically kind of participates in that industry. So quickly, by way of background, to define venture capital, it's an investment strategy and a form of investment as listed here, focusing on private companies. And the appeal to investors is it gives investors an opportunity to participate at earlier stages in companies' development and hopefully capture the value that accrues in sort of its early, sort of formative years. We like to think about a couple of defining characteristics of the companies that we pursue and the portfolios that we construct, really along sort of three dimensions. The first is, as referenced in this opening bullet point, venture capital is a private market investment strategy. So all of the investments that we make are in companies that do not have any sort of registered form of securities. They're not listed and liquid and tradable on any form of exchange. All of the investing activity we do is the direct result of direct interaction and direct negotiations with companies directly, sometimes with some intermediaries, but these are private companies at the time of our investment. And the impact of that is a couple of important considerations relative to public market strategies. First is that we're going to spend a lot of time today discussing sort of how we try and break down individual companies and make an informed investment decision. And obviously that's critical. Equally important to the success of our company is our ability to be in the market and actually accessing these opportunities, because you can be incredibly proficient at the analysis side, but if your opportunity set is stacked against you in terms of adverse selection, or you're just not getting access to the most promising deals, you're not going to be successful in the long term. So I just wanted to make that clear. The other thing, which is equally as important, is that we underwrite all of our investments with the expectation and the assumption that the companies will remain private for the overwhelming majority of our hold period, which is to say, we look to be invested for a fairly extended period of time relative to a lot of other investing strategies, and are really reliant on significant events like the sale of a company, an IPO, or a major recap in order to get our money back and hopefully harvest gains. So when we're going through the specifics of deal evaluation, it sort of underscores the importance of really being thorough in your analysis, because if post-close something happens that changes our analysis, or we realize we missed something, it's not an option like it is in a lot of other investment strategies, just to unwind the position, take our money back, and move on to better opportunities. We own these investments for the duration. The second clarification and sort of pillar of venture capital that I wanted to clarify is the strategy is really focused on investing equity securities in operating companies. There's a lot of other sort of technology related and early stage related and speculative activity that goes in and around sort of related ecosystems. I'm thinking specifically about investing in cryptocurrencies and other digital assets and things like that. But from our standpoint, the way we practice venture capital and how we think of the industry is really partnering with operating businesses and investing kind of shoulder to shoulder with the founding management team in a way that the performance of those companies and their ability to grow into lasting, sustainable, profitable businesses is really what dictates our success or failure. So you see, as we think about our company-specific analysis, it's very bottoms up and fundamental along those lines. And third and finally, while the private aspect and the equity aspect are prerequisite, they're not sufficient in terms of defining what venture capital is, which is to say, the profile of the business is also very important. If you have experience with your neighbor decides he wants to make a career change and is going to raise money for a food truck business, that may be private and it may represent an equity opportunity, and it may even be a promising investment for you, but it wouldn't really resonate with the venture capital community. The businesses that we are evaluating, and certainly the ones that we're backing, tend to have a lot of ambition behind them. They aspire to disrupt existing markets, open up new markets, and build around a sort of a foundation of innovation or some intellectual property that makes them feel like they have the opportunity to really kind of grow into significant and highly valuable businesses over time. So the venture industry is really focused on hitting home runs, and I'd even say hitting grand slams, as opposed to sort of steadily, kind of chipping away with singles and doubles. By way of background, there's a couple of companies listed here. These obviously are sort of the aspirational types of experiences that venture capital investors are after. I did some math before this call, and the companies on the left add up currently to about $11 trillion of market cap. But each of these businesses in their early stages, from sort of concept and business plan through to getting sufficient traction where they were viable public market candidates all started their journey as being venture-backed companies. Next slide. So this gives a little bit of a historical perspective on what makes venture interesting and why people go through the hard work of trying to build these portfolios. I mean, and as you would expect, given the sort of lack of liquidity that I described in the previous slide and the risk profile of early stage businesses, you know, the expected returns here are a premium to generally what's available with a diversified strategy in public markets. And there's a couple of sort of benchmarks here comparing the performance of an index of venture capital investments over several different time periods relative to what's available by investing in the S&P. And you can see sort of outperformance in the zip code of you know, 3 to call it 500 basis points has been pretty long-standing and sustainable. You know, the important thing to call out here is similar to public markets. You know, these expected return numbers represent averages, and there's a lot of volatility around these averages as you sort of look back, you know, through the time series of the data that builds up to these numbers. So one of the important things that we try and impress upon investors who are evaluating participation in venture capital as a component of their investment strategy is to really understand the value in sort of being steady, consistent, not trying to wade in and time markets, but to really view these as investments that are going to take several years to play out, and you're best served by a consistent, diversified approach. Next slide. You know, all that being said, the venture marketplace, like most asset classes, you know, does go through various cycles. And, you know, there's a sort of a constant push and pull between the availability of capital and the appetite for capital on the part of entrepreneurs and founding companies. And there's also sort of an ongoing push and pull between the availability of capital that's allocated towards risk assets versus capital that is sort of earmarked for kind of more safe and predictable and therefore lower return investments. So the venture industry certainly goes through, you know, cycles, and you can sort of see some of the shape of these cycles over the last several years, and we expect that to continue. Where we are currently is, you know, an environment that sort of takes its cues from some of the volatility and turbulence that public markets have experienced as we sort of migrated from a zero interest rate regime that prevailed during the pandemic. Is you know, sort of a recalibration of the balance of power between companies raising money and investors that are allocating capital to those. So this chart shows a sort of a composite index that's compiled by PitchBook, which is a data source in the National Venture Capital Association. And it's just meant to indicate that in the current environment, looking at, you know, as broad a cross section of deal terms as possible, that one of the sort of silver linings and current effects of you know, some of the disruption that the industry's gone through coming out of the 2021 and 2022 time period has been that terms like valuation, step-ups in valuation relative to company progress, governance, and all of the terms that sort of translate into a deal being more or less investor friendly have kind of rebounded to a pretty attractive place in the current environment that sort of, you know, reverts back to levels in more sustainable environments like we saw kind of in the 2013 and 2014 timeframe. So we wanted to call that out because we do have a lot of questions, and we'll dive a little bit deeper into it with people trying to understand all the changes that have taken place with asset values and sort of market fundamentals over the last 24 months or so. You know, kind of how is that translating into drivers of our business and you know, our level of expectations for future returns. Next slide. So to talk quickly about Alumni Ventures, our specific business model, and kind of how we fit into this ecosystem. You know, our focus is very much on providing diversified portfolios for our investors. Unlike a lot of firms that overwhelmingly focus on large institutional investors, which have the ability to construct their own programs, you know, relying on multiple managers to sort of build up a diversification through you know, a multi-manager program. We approach the business with the expectation that we are either 100% or at least a significant share of our investors' access to venture capital, which means it's important for us to provide a requisite level of company diversification in portfolios because it's a big determinant of sort of maximizing risk-adjusted returns. And largely for that reason, we approach the market as co-investors where we're looking to partner with some of the most active and successful lead GPs as opposed to competing directly with them. So we target our approach in terms of portfolio construction, and we'll get into it in the body of the masterclass, really around identifying companies that we think have great promise and trying to look to the behavior of some of venture's most sophisticated investors in terms of their level of engagement with the company and commitment to the company as an indicator of future success. The chart on the right shows that in some ways very different to active management in public markets. The venture business definitely shows a lot of dispersion between the investment performance of top managers relative to everybody else. And there's a lot of reasons for that. There's a lot of companies a lot of investors that have a tremendous amount of history in this strategy, have franchise value, have partners that have a lot of pattern recognition, and have reputations that means that some of the most promising entrepreneurs sort of seek them out because they have a halo effect. And so we obviously wanted to focus on investing alongside those investors as a way to get access to what we think are likely to be the most promising investments, and kind of capture the upside of that strategy and pass it along to our investors. Next slide. So as I said in some of the opening remarks, a lot of our time and attention is focused on company-specific due diligence and investment analysis. And that's obviously critical to what we do, and really, sort of where the future success sort of hinges is making intelligent and consistent decisions with the deals that we evaluate. We have a process that we think serves us well, in service of that primary objective. But one of the things that we need to make sure that we're doing, because we are processing a significantly high volume of deals, is to make sure that all of our decision making is consistent across the organization, is consistent from deal to deal, and sort of keeps us honest, so that we make sure that even if we're operating with somewhat of a decentralized model, that we are evaluating things sort of largely from the same playbook. This gives us, we think, the advantages of getting to yes with kind of a consistent view of the world. It also helps us get to know quickly, which in our business, as we'll talk about later, is critically important, because we're in a return on time industry, and we can't be efficient if we spend a lot of time evaluating deals that have no prospect of getting approved. And it also provides some protection, given our model, to make sure that we don't have a extended sort of appeals court, that if an entrepreneur is interested in getting a review of their deal and they don't like the response of one of our deal teams, that they go to others and try and get a different response. So in service of all of those objectives, we've developed what we refer to internally as a scorecard, which we're going to go through in detail now. And the scorecard really is a framework that lays out for our deal teams and all the way up to my office to review deals, like I said, on a consistent basis, outlining what do we think the critical kind of predictive variables are for us to understand. So we get a comprehensive picture of which deals amongst all those that we review we think have the highest likelihood of success. So we're gonna kind of turn our attention to going through that scorecard in detail. Like I said, this is something that we do as an internal discipline. All of our investment teams are well trained in this process, and we try and have independent scoring across everybody in the team to get the benefit of diversity of opinion and points of view. But it's just a good tool, like I said, to make sure that we have consistency and we can handle effectively the volume of deals that we have to evaluate in order to get to the portfolios that end up getting invested in on behalf of our investors. So next slide. All right, I'm going to turn things back to Andy now. We're going to go through some of the individual segments of the scorecard and give you some examples of companies that sort of stand out in our mind relative to the criteria in the specific section of the category.
Great. All right. Well, thanks, Mark.
Yep.
So diving into the scorecard, there are 4 categories that we're going to take you through. And the first of these categories is deal dynamics. So really digging into the round and how it has been structured. So there are three main subcategories here. But before we go on, I do want to reiterate Mark's point as a reminder that AV is purely a co-investor. I mean, we don't lead rounds, and so all of these things need to be viewed through that lens. So let's start with round composition. Is the round being led by a brand new investor? Meaning that, is this the first time that firm is investing in the company? Or is it being led by an insider or a firm that's already invested capital in the company in prior rounds? And if you think about it, you can understand how this leads to different incentives for the lead investor. So when I say lead investor, I'm talking about the one setting the terms of the round, setting the valuation, the structure, et cetera. So if I'm a VC that has already sunk $10 million into a given company, I've got different motives compared to a VC that has never invested before and it was writing a check for the first time into the current round. So all else equal, AV wants to be investing behind brand new investors because our incentives then are more purely aligned. There are exceptions to this. So sometimes a company can be killing it, and they're growing rapidly. And so existing investors sometimes will step up, offer the company a term sheet to prevent the company from raising outside capital. And obviously that's a good situation to be investing into. So the trick is really differentiating between those two situations, really digging into the motivations at play from the various investors around the table. Second category here is valuation and terms. This is really about how the deal has been structured, including but not limited to the valuation of the company. And when I say valuation, I mean how much of the company investors will own after they invest. We evaluate this based on both internal and external data. And essentially, we're looking for how the terms of the deal compare to an average deal, for that company's stage and sector. And then finally, on the bottom left here, we've got runway. So based on the amount of capital that the company is raising, how long can they go before they need to go back out to market and raise another round? So for example, if a company is spending $2 million per month to keep its business running and raises a $15 million round, do the math, that really only gives them about 6 months or so before they need to go back out to market again. And this is important because you want a company to be able to achieve certain proof points and realize a step up in valuation prior to raising that next round. So we're typically looking for a company with at least 18 months of runway. It's a little bit of wiggle room there depending on the stage of the company, but 18 is typically minimum, 24 is ideal. So a quick example of an AV investment that I wanted to highlight in this category is in Fabrica, which is a designer and developer of powerful computer chips to support the development of AI applications. So this company closed Series B in Q3 of last year. And Sutter Hill Ventures leading the round, taking half the round, in fact. And this is an example of an investor who previously backed the company. They weren't a brand new investor, but they were stepping up and significantly increasing their ownership stake in the company because they really liked what they were seeing. They liked the traction, they liked the direction of the company, so they wanted to own more of it. Plus, the partner at Sutter Hill, who's leading the investment, Stefan Dijkerhoff, he was the lead partner on a very similar investment, unicorn worth multiple $1 billion today, called Lacework, which actually AV is also an investor in. But so he knows this space very well. And he's joining the board here, a sign that he's highly engaged. So we were very excited to be back in this company with Sutter Hill and Stefan leading the round. All right, Mark, over to you.
Thank you. So next main category in our scorecard is just an analysis of the lead investor. And I think, as you heard from Andy in the first category, there's some overlap, I think, in terms of interpreting these things. But this is really, less focusing on things that are deal specific, but really kind of looking into the track record of the firm and specifically the partner at that firm and trying to create alignment between what we think the real opportunities and challenges that a specific company are going to face, and does the relationship between lead investor and CEO make sense and have the a heightened level of potential to be positive and fruitful, looking at historical track records. So obviously, a lot of investors that we invest behind because they've been around through various cycles and have sort of the scar tissue to prove it. And so there's a long historical track record that I think we think is maybe not dispositive in terms of the future likelihood of success, but it's definitely informative. Does a partner have the combination of pattern recognition from historical investments and current investments? Do they have sort of an execution playbook that has been developed, not only through successful investments historically, but some of the more challenging investments, which is equally as important in terms of developing expertise and the ability to sort of navigate through investing with companies at this stage of development. And then equally as importantly, does the partner have and the firm have access to relationships that can be impactful as you're building a business, that are relative to the specific industry of focus, and kind of creating an extended board of directors, if you will, on behalf of the management team, of people who have relevant experience that can kind of bring to bear and sort of create the feeling of an advantaged company with what they're trying to accomplish. So it's a pretty comprehensive analysis of all of those factors. And if you look at our portfolio, you'll see kind of a fair amount of consistency with specific firms that we target and value very highly for specific types of investments. And the same is very much true of individuals at those firms as well. An example of one of these companies that sort of stood out in our minds in terms of our analysis of the lead investor is a recent investment in a company called Sense. Sense is a New York-based vertical market software company focusing on bringing value to independent operators of both laundry operations and dry cleaners. So in many ways, sort of a backwater type of business that doesn't stand out as a candidate for venture investment, but is consistent with sort of a thematic approach that we have pursued and have seen, which is in software. There's a lot of terrific value to be captured by taking a vertical market focus approach and choosing not to compete, sort of with the large enterprise players of the sales forces of the world, but designing a very, very specifically built and implemented solution that focuses on the specific business needs of companies in an industry vertical. And we've seen plenty of examples with companies like Toast and Built and some others really execute this strategy and build meaningful and very valuable companies. And we see the same opportunity in Sense. One of the reasons why we got so excited about Sense is that we not only saw that opportunity from a bunch of thematic work that we have been doing, but the leadership team that is sponsoring this investment is also very thematically oriented and has a tremendous amount of success stories with companies that have a lot of similar attributes to Sense. Bessemer Venture Partners being the lead investor, and a partner there specifically by the name of Kent Bennett has done a lot of successful investing in vertical market software companies, and so definitely has a playbook that we think is going to be directly relevant to this company, which you can see by the Series A round is still kind of in its early days of development. What made this one equally as compelling in terms of involvement of the lead investor is that in addition to a world-class venture investor leading the round and serving on the board, the CEO of this company has attracted the interest and actually convince executives to reach into their pockets and write a check. So we are co-investing in this deal alongside foundational management team members at some of those same companies that I mentioned that have already executed for several more years with these types of strategies, companies like Toast and Stripe. So it's really a significant validation of the opportunity from people who have already had a very, very significant exit event in a related business. Next slide.
All right. So the third category of our scorecard is execution. And this is really what I'd call the typical diligence questions around how the company has been performing. So we've got customer demand. we would evaluate this one a little bit differently based on the stage of the company. But essentially, has the company proved customer willingness to pay? Have they secured revenue and paying customers? Or depending on the industry, have they overcome certain industry-specific hurdles, like FDA approval for biotech, et cetera? Number 2 is business model. So how profitable and scalable is the mousetrap that the company has built? Third is company momentum. And we want to catch a company logically at the beginning of a big upswing, right? As opposed to catching it at the top of that upswing. So doing our homework and making sure that the company, as best we can identify, is at the cusp of that upswing is really what we're looking for. Next is capital efficiency. So how well has the management team used the capital that they've raised to date? Are they a scrappy team that's making every dollar last? Or have they spent frivolously in the past? This is usually a good indication of how they're going to use the next round of capital that they raise. Competitive moats. So what is the company's differentiation or secret sauce? And is that going to be enough to allow them to outperform competitors as they grow? Now, an example of an AV investment that I wanted to highlight here is Yasir, which has developed a super app, think ride hailing, grocery delivery, payments, etc., that targets French-speaking Africa. And you may think to yourself, this is a relatively small market, but it's a lot bigger than you would think. We originally backed Yasir in their seed round in early 2020, and since then they've grown dramatically. They raised a 150 million Series B back in 2022, led by Mary Meeker at Bond Capital. And we just had a chance to invest for the 4th time recently in their Series C. And the thing that really jumped out at us is that if you looked at the metrics that this company was demonstrating, it was really astounding. They were growing revenue 2 to 3x year over year for multiple years. And at tiny dollar volumes, that isn't, it's great, but it's not amazing. But Yasir is generating hundreds of millions of dollars of revenue currently. They're a leading player in the market with plenty of headroom to keep growing. So we were really excited to double down in their Series C. This was likely the company's final round of financing, and I wouldn't be surprised if they intend to go public in the next couple of years. All right, Mark, over to you.
Okay, next slide is team. And of all the things that we've talked about now, I think this one is probably the most subjective, but it's also probably the most critical piece of the diligence that we do, and I think ultimately where sussing out the winners from losers, kind of upfront is this is a most critical piece of that analysis. Even though we talked about our model is focusing on being co-investors, it's important to call out that in our diligence process, everything is done in direct interaction with the company. So while it's important for us to get on the same page with the lead investor, understand their thought process, share access to their diligence findings, and sort of develop a constructive relationship there, we are relying on interactions with the senior management team and the CEO specifically in all cases to answer our questions and to get us comfortable with the investment profile. And part of that is just the process of gathering information and trying to get our questions answered, but part of it is just the process of trying through interactions with those managers to get comfortable, obviously with the sort of non-negotiable aspects of honesty and integrity and intelligence and things like that, but also digging deeper and trying to sort of get a sense of leadership styles, managerial talent, the ability to attract and motivate and retain a high quality team, the ability to face the market and kind of instill confidence in prospective customers or partners, the ability to manage relationships with outside capital providers. All of those types of things are an important part of our kind of overall assessment of the team that we're backing. And by the way, during this process, the team is doing exactly that of our team as well. So it's it's really a process of trying to sort of triangulate in on a mutually beneficial partnership. We've backed CEOs and management teams that have a real variety and diversity of backgrounds, perceived strengths, and the like. So this is one where there's certainly, indications that get us comfortable, but I don't think there's anything that sort of universally applies, which is to say we've had tremendous success and will continue, hopefully going forward, in backing repeat founders, in backing first-time founders, in backing people who have, incredibly focused and specific industry experience and an opportunity that they're trying to pursue, or people that, come in laterally from a totally different industry and bring a fresh perspective. So it's difficult to, sort of really zero in on all of the things that go into this analysis. But it's an area that we spend a significant amount of time on, and part of the benefit, like I said, of our approach of having multiple people all going through the diligence process is that, you tend to get a diversity of opinions represented before we make an ultimate investment decision. One example of a company that we recently invested in that had a real positive experience in terms of the interaction with the management team, but took the deal very seriously going in before we really had the opportunity to spend a lot of time with the team, is a company called Impulse Space. And this is a relatively innovative business that is sort of bringing, think of it as last mile logistics, for the emerging space marketplace. So kind of transport mechanisms that are already in orbit and can take, payloads that are kind of being launched up into orbit from Earth, and parcel those out and sort of bring it to their destinations with a lower cost model. And one of the things that really stood out here is that the CEO and founder, Tom Muller, is actually the first outside employee at SpaceX and was there for an extended period of time, really was the technical genius that got their propulsion systems designed and developed, and largely to where they are today. So not only for a business like this is it really encouraging to have a founder with such technical expertise and track record and reputation, but obviously in this industry, having been a foundational player to get SpaceX, on the path to where they are right now, just creates a lot of credibility with other industry partners, attracting a lot of investment capital from people who have had success investing in SpaceX, and just sort of all of those, what you would expect flywheel effects. So we wanted to call this one out as an example. It's probably one of the easier ones to evaluate, given the unique nature of this founder. But these are definitely the types of things that we look for and try and tie them back to what we think the character traits of a successful leader are, specific to a business profile that we're investing in. So next slide. So quickly, before transitioning and sort of scrolling back out again, I wanted to mention in the control panel, there's a link labeled handouts. And if you go into that, you'll be able to find a PDF of the scorecard that we just discussed that you can download and sort of keep for future reference, that provides a little bit of detail. We probably should have let you know earlier. People were kind of scribbling copious notes during the discussion, but that is posted in the handout section on your control panel if you're interested. But as I said at the outset, we've adopted this approach, and we kind of approach it with a level of humility that every deal is different, and we try and be as comprehensive as possible in screening our deals and getting to the right answers. But we understand that even with this approach, there's sort of an element that we try and capture that is individual decision making and kind of a craft element of the business. But given the volume of opportunities that we're looking at and the importance of sort of processing those efficiently and consistently, and as I said at the outset, the importance of kind of getting to know quickly with deals that just don't make sense, either based on what our take of their investment prospects or just not being a good fit for our business model. We've developed this process, and we abide by it with a lot of discipline. As you can see here, venture is a very low hit rate business in terms of deals that you actually choose to invest in relative to the number of deals that you evaluate. Borrowing sort of a metaphor from Warren Buffett, you need to be prepared to take a lot of pitches in this business before actually putting money to work, and I think that's entirely appropriate. our sort of conversion rate, if you will, relative to the number of situations that we get pitched on and get access to do some work on is probably around 5% or even less. And so we're really in the business of saying no. And it's, like I said, it's critically important to sort of maintain a consistent process so that, the no's sort of add up as being consistent. But most importantly, when we do kind of navigate the process and get to yes, the companies that kind of get through this Hunger Games process really are curated around those that we think have the highest likelihood of generating attractive returns for our investors. So while the scorecard process and the review process that we discussed here is something that really kind of relates to, if you go to the next slide, Taylor, really relates to individual company investment decision making. We wanted to make clear that all of this is done really in service of taking an approach for our investors of providing diversified portfolios of companies that not only stand on their own in terms of the review of their individual investment merits, but all make sense in the context of being investments in a portfolio that has a requisite level of diversification in terms of the number of companies in that portfolio, but also being mindful of trying to create diversity around stage of development, sector of the economy, the lead investor that's involved in the transaction, and even geography, because a lot of venture markets tend to be somewhat regional in nature. And we really view taking this diversified approach as sort of foundational to a program that has the highest likelihood of success for our investors. We have multiple products that really kind of focus on providing this level of diversified portfolio for investors. Some that are what we refer to as alumni funds that tend to appeal to graduates of schools that are kind of in our product offering. We also curate diversified portfolios that are kind of focused on a specific investment theme, whether that's an industry sector or things like investing in female founders or some things that are kind of more company specific. And then we even have a highly diversified fund that populates portfolios essentially with a slice of every investment that we make. And like I said, all of these things are things that we view as being foundational to our value proposition to our investors. It's difficult enough to go through the process of sourcing and evaluating individual companies, but we take it a step further to curate portfolios, handle all the portfolio management associated with that in terms of monitoring the investments and handling capital calls and follow-on investments, and then ultimately exits, and roll that up into a single product, with a single K1 at tax time to kind of really be like a fully outsourced investment management service for our investors for their venture strategy. That being said, in addition to these fund products, we do offer a product called Syndications, and Andy's going to go into a little bit more specific detail about the nature of this program. But these are companies that all clear the same investment process that we just went through and have deal teams that are looking to build their portfolios, approving the deal and managing them. But for a whole host of reasons, we think they're particularly compelling. We're able to get additional allocation. And for existing investors that participate in some of our fund products, we will show them to you directly. And if you're interested in sort of developing your own venture muscle in terms of evaluating deals, and you're comfortable with the implications of having a little bit more concentration in an individual company relative to relying on the diversification provided by our fund products, it's an interesting element of our investment offering. So we're going to kind of shift gears a little bit and have Andy sort of walk through some of the specifics of syndications just to make sure that people understand that it's out there and give you some instructions on how you can learn more and get involved if it's something that appeals to you.
Awesome. Thanks, Mark.
Yep.
All right, and I'm going to try to speed through these slides relatively quickly. I know we're running short on time. So I'll cover the most important points. First of all, what are syndications? Syndications are opportunities to invest in a single venture deal. Now, these are deals that AV sources just like any other deal. They're deals that one or more of our funds are already investing in and from which we've been able to secure additional allocation. So, for example, we may be able to find a deal where our funds are writing $1 million check, but we're able to secure an incremental $1 million for our individual investors. We then extend this incremental allocation to our investors, sharing our diligence material and giving folks, a week or so to make a decision whether or not to invest. The other important point I want to mention here is that the minimum check size for syndications is $5,000. This is very deliberate. It is not the same as our minimum check size to access our funds. It is lower. The reason is we want our investors building diversified portfolios. And Mark alluded to this, syndications are highly risky investments. The nature of venture investing is that you have a lot of zeros with relatively few investments producing big outsized returns. So we don't believe any of our investors should be putting, half of their investable capital into a single deal. It's more about diversification and then customizing your existing portfolio with certain opportunities that you want a little bit more exposure to. All right, next slide, please. So when you see a syndication opportunity come through, you'll be presented an option to log into our secure data room, where you're going to find key diligence material for the deal. And this typically includes the materials you see here on the left. So the diligence report, this is AV's diligence report. I would argue this is the most important document to review. This is, our assessment of the deal, what to like, key risks, that type of information. The other information here, investor presentation, term sheet, capitalization table, financials, that is all information provided directly by the company. So it more reflects the company's how they're presenting themselves to the world, their growth plan, their financial projections. So our assessment of the deal in the diligence report, may say that, hey, the company's financials are a little aggressive or conservative or whatever, but the diligence report is more AV's take on the deal. Next slide, please. All right, so a few sample syndications that I wanted to highlight. One of the key things here is that we present a lot of different types of deals for syndication. Variety by stage, sector, geography. We do this for a lot of deals. So on the right, you can see Surge Therapeutics. This is a technology that allows surgeons to deliver immunotherapy inoperatively to help reduce the chance of cancer recurrence. This was a deal that we originally invested in back in 2021. And we also recently participated in the company's Series B last year. Status Pro is another one listed here, second from the left. This is virtual reality video games. So they're producing VR gaming for VR headsets, like the new Apple Vision Pro. The company has partnered with the NFL to produce these games. And interestingly, Status Pro is the first company to secure NFL simulation rights outside of EA Sports in the past 17 years, which I thought was kind of a cool fact. I'll highlight one more here before moving on. So Ascend Elements, this is battery recycling technology that's more efficient than previous methods. We originally invested in this company last year. Also invested fairly recently in the company's C round, Series C round. The company has secured a $500 million grant from the Department of Energy, plus a large contract with one of the largest EV manufacturers in the US, which you could probably imagine the name. All right, so before we jump into Q&A, I did want to mention that if you'd like to learn more about upcoming syndication opportunities, next slide, please. So we are launching another syndication this week. You can click on the link below or the link provided here to express interest. Now, reminder that these opportunities are only available to AV investors. And plus, in addition to that, if you would like to learn more about any about these opportunities, if you're not an AV investor or would like to speak to someone about getting a better handle about these opportunities or any of our funds, please book a call in the option in your GoToWebinar panel. All right, so with that, let's get into Q&A. We only have time for, I'd say, 2 questions because we're running a bit over.